Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today, let's talk about fees and can they destroy your retirement income? So yes, they can. And specifically, we're talking about annuity fees, okay? I just spoke with a gentleman yesterday about his variable annuity, and he was paying like 3.5% to 4%. He's like, yeah, this is eating everything away. And then we were looking at his guaranteed income, which he did have a rider attached, and you can have those attached to a variable annuity. And out of his balance, I mean, it was a big balance, like $1.7 million. And he's going to get like $88,000 in lifetime income, okay? And that's guaranteed. But he wanted a higher guaranteed income. And I laugh because it's just like he's paying these huge fees and he can have more income. And we looked at some other options and he could like double it. It's like $177,000 in lifetime income, guaranteed. And the fee's like 1%. So, fees can definitely ruin your retirement depending on how it's set up. As far as your income, and this is what this video is about, is can it destroy your retirement income? I mean, I suppose it could, but with an annuity with a fee, if it's a fee for like an income rider, no, it's there for your income. Okay? It will not destroy, it will destroy your account balance, right? Over time, it will take your account balance down as well as your withdrawals, and you'll get credits on the index. I'll show you my screen. I'll show you what it looks like. But if you're buying it for income, you could care less about, you don't care about the account balance. I mean, you do, but you don't. Okay, that account balance is going to be there, but it's going to be gone in like 15 years. Okay, let me show you. All right, so I'm going to pull up my screen here, and I've got someone in Pennsylvania. They got $750,000. They're purchasing this for them and their spouse, who they happen to be the same age as, and they're going to take income at 67. So they're going to wait till Social Security starts, and they're going to activate income from this $750,000 annuity. Okay, so they're going to buy this and they're going to choose Nationwide for this. Well, you know what? I show so many Nationwide options. I'm going to show Corebridge this time because Nationwide has just been on top for so long that a lot of my videos will be taken up by Nationwide. And they're a great company and I highly recommend them. But I want to show you Corebridge because Corebridge, they have enhanced payments. That's LTC care. That's kind of nice. But it's only there for a limited amount of time. Like a limited time offer, right? Because it's just a liquidation benefit. Let me show you what I mean. So they're still giving you that same income. It's like $78,000 a year, guaranteed. I'll show you what it looks like. All right, $78,000 guaranteed for the rest of your life. Balance doesn't last because if there's no index growth, it runs out by the time you're 74, 75. If there is index growth, they're not going to give you very much, and it'll still last to like only 77. So in the end, you're spending $750 for a $2.2 million pension if you live till 95. If you live longer, you get paid out more. Simple as that. Now, for the LTC, they double it. See right here? But it's only a limited time because it's just a liquidation of your account value. Okay, so if you need LTC care, yeah, you can have it, you or your spouse, and they're only going to give it to you for up to 5 years or until the account balance runs to zero. After that, it reverts back to the $78,000. So that's why I'm showing you this compared to the Nationwide, because they give you that. Nationwide does not. That's pretty nice. Okay. Their fees are a little bit lower too, but they're still high. Look at this. That's what this video is about, is fees. We look at this and say, all right, well, that's like a lot. Okay. And you look at that and say, well, that's for like 14 years. Yeah. 14 years, like 150 grand. Wow. That's a lot of fees. So yeah, it's eating it up. It's eating up this account value. The income is eating up your account value, and the interest rate that you're earning is adding some credits, but it's not going to be enough, right? But the income, that's why you buy this. It's for lifetime income. Who cares about the account balance? It does not matter. It's going to run out. Okay. It's designed to run out. So if you're like, oh, I really hate fees, John, I hate them. Okay. I want lifetime income though too. All right. That's fine. I'll sell you something without fees. You go up here and say, okay, no rider fee. Okay. We still want lifetime income, but we don't, no fees. All right. Well, it's 46,000. So definitely not as high. And Midland is showing you, here's what it'll look like if there's no growth, then it's just pure income. And your account balance lasts way longer to like 83, 84. Pretty good. And you can see over here, there's no fees over here. So pretty nice. It's just the income's a lot lower, right? If you compare that and you're like, okay, 78 versus 46. It's like $32,000 less income. I don't even need to do my calculator. Okay, that's like it's like almost $1 million over 30 years. That's what that is. Okay, you're spending 150 grand for an extra $1 million in income almost. Okay. Your net, just look at your net. That's what I look at. It's like, okay, I don't like being charged a fee, but if I am paying a fee, what am I getting for it? Well, that's what you're getting for it. Yes, it's drawing your account balance down faster, but you're locking in a high pension. So usually that's the best option. So they show you this option. Hold on, let me go back to Midland. So Midland shows you, here's what it looks like if there's no growth. Well, you're going to get some growth, okay? But at least this is the bare minimum. Then they show you, but here's what we'll do if you get this growth. You'll still get higher income. It'll be lower than this. Then obviously we're looking at the 78 versus 64, but this has to perform. This index has to perform. They're giving you some of the S&P 500 subject to a participation rate of like 40%, and they can change that par rate every year. So that really will fluctuate. But based off of that, yeah, you're going to get this higher income, and your account balance will last forever. It looks like by the time you're 95, it's like $267,000. So this is not a bad option. You just have to realize this is purely hypothetical. Okay. I don't think you're going to start out at 46. Okay. This is extreme too. This is showing no growth. But let's say you start out in the middle. Let's say it's like 52 grand. Okay. Okay. You get 52 grand for the rest of your life, and your account value has to have this growth over this time. What if it doesn't? Then the account value will not last. Okay. So you just have to realize that's how these work. But as far as a fee destroying your retirement, it's not going to destroy it. It's going to add to it. In my opinion, if you pay the fee, you're going to get higher income. If you don't want to pay the fee, then just put it in a no fee option for growth. Don't even worry about the income. Throw it in an annuity that does not give you the income rider. It just gives you straight growth. You get a lot more than these, and there's no fees. Okay. So I do both, and I set people up with those so they can have some legacy, some growth products, as well as the guaranteed income products. So the question is not whether or not a fee is good. It's just whether or not it is something that makes sense for you. For most people, it does. For most people, they're like, I care about the net. I care about the net income. That's all I care about. And I could care less about the account balance. It's going to run out in 12 years or 15 years. It doesn't matter. It doesn't matter. I want the income. And that's why you buy it. So it just depends on what you're looking for. So if you got a variable product and you're paying high fees, that could definitely drag down returns. You can do a product like this and pay fees, and they're going to give you something in return. You know exactly what it is. Okay. There is no question. There is no guessing game. You know what it's going to be. So anyways, I hope this is helpful. If it is, make sure you like, subscribe, and share. If you got questions, comment below. If you want to buy an annuity with me, please book a call. There's a link below this video. Go directly to my calendar. Otherwise, go to my website, check out the annuity options, and you can book a call right there as well. So I try to be transparent. I try to show everything that's here. Okay, there are tons of options. Okay, tons of options. And some of these pay me great commissions, and some of them don't. Okay, it does not matter to me which one you get. It matters to me that you see it, and then you can make your own decision what you want. Okay, I would love to sell you. I'd love to sell you. Let me see if I can find a high commission product down here. Please buy this. Okay. I get 3% more on my commissions on this. Okay. And a lot of guys will sell it. It's Allianz. Allianz a good company. 3 trillion assets are great. Okay. And they are great. I could justify selling it to you because they're a good company. But you compare that and you're like, oh my goodness, I get from an A+, I can get 78. Yeah, I think I'll take that. Over like 67, that's like $11,000 more in income. See? So yeah, I try to be transparent. Okay. I'm going to show you everything that's available. You pick what you want. I'm going to make my suggestions. I'll make my recommendations. And of course, I'd love to help you with it. It takes about 3 weeks, start to finish. So if that's something that works out for you, I'd love to help. If not, that's fine too. So anyways, hope this helps. Hope you enjoy the video, and we'll see you next time.